Hi everyone, it's Cherry Chen from Real Estate Tax Tips again. Happy Monday. Today I'm going to go through the tax impact if you were to refinance a property inside a corporation. In my previous two videos, I mentioned the possibility of refinancing your own home and take out some cash from your equity, from the equity accumulated in your home. And I've also mentioned tax impact if you were to refinance the property in your personal name. And someone mentioned that someone asked the question if I can go through the tax impact if the property is owned directly in the corporation. And today I'm going to go through that question. Now, let's just go through our back end example again. The old mortgage was 320 and now the new mortgage is 480 and cash available is 160. The only difference is that this property is now owned in the corporation. What is the tax impact of this refinancing? Just to remind all of you, the interest deductibility rule in Canada is that it's based on the direct use of the fund. So depending on what you are using the fund for, you may or may not be able to deduct the interest related to this additional $160,000. So let's step back a little bit. If you're using the fund to purchase an additional property within the corporation, definitely 100% tax deductible, the interest expense on this $160,000. If you are buying another property or doing some other investment, doesn't have to be property, but it has to be for investment purpose. So you can use it for business use. If you are like me, have a small business and you use that $160,000 to continue to build your business, then that interest expense would be also tax deductible, assuming that the business is within your corporation structure. If you're buying another property in a second corporation and you loan the money from your current corporation to the second corporation, again, the interest would be tax deductible. Now, if you take the money out, the last one, if you take the money out, the $160,000 out, and pay off your primary residence, then there may be a tax impact on your personal name. Now, typically speaking, when we set up a corporation to invest, the corporation is a newborn baby. It has nothing in it. So when you purchase a property, essentially, you loan the money from your own pocket, right pocket, to your corporation's left pocket. So essentially, you're loaning the money from your own bank account to the corporation bank account. So then that would allow the corporation to purchase the investment property. And if that's the case, any loan amount that you retract, any money that you retract from the corporation that is smaller than the initial amount that you invested in the corporation, that would not be taxed. There would not be any tax impact on this money. So let's just use an example. For example, if I loan my company $100,000 to purchase a property, and now I refinance the property, now the corporation will repay me $100,000 because I got refinanced money for 160. The initial $100,000 repayment would not be tax deductible. Would not be taxed in my name. But if I take out more than the $100,000 and assume the corporation only owes me $100,000, then this additional $60,000 would be taxable in my own name. So the answer to the question, what is the tax impact within the corporation? It's really complicated. So it also goes back to how many properties you have in the corporation. It also goes back to if there is any other related parties and how it's being structured. So definitely we need to look at your balance sheet and also your financial statements to make sure that it works. Until next time, happy Canadian real estate investing.